Now, there's a little known fact out there when it comes to paying your insurance policies through your super fund. The super fund may be taking your tax refund from you. Now imagine this, you go and do your tax refund every year and you get $1,000 refund from your tax return, and your employer decides that they will keep that tax refund. Now that would be considered theft, that's illegal and not allowed, but when it comes to superannuation and insurance premium tax refunds, the super fund can legally withhold that tax refund that the members should be getting access to. That sounds really dodgy, and I agree, but I'm going to call out some of the biggest super funds who are doing this. So let's start off with Rest Super. Rest Super is one of the biggest super funds in Australia, and in their PDS, which no doubt every member's read because it's only 60 pages long, buried in the PDS on page 44, you can see that Rest receives a tax deduction for the insurance premiums, and this tax benefit is paid directly into the insurance reserve. The insurance reserve is used to cover the cost of running our insurance administration and for the benefit of insured members of Rest through reduction in future insurance premiums. Fantastic. Now what that means in reality is if you are paying $1,000 worth of insurance premiums, the ATO or the government gives $150 back as a tax refund. So 15% tax refund back to the superannuation fund. If you're within Rest, they don't pay that back to each member's account. They withhold that tax refund. And they say for the benefit of keeping the insurance premiums affordable for future years. Now that can make sense. If the super fund does withhold that tax benefit and is considering making reductions in premiums for the insured members, look, they are saying it is to reduce the premiums, so theoretically the premium should be cheaper, but unfortunately this isn't the case. Now as financial advisors, we've got a lot of software where we compare every insurance policy on the market basically, and what I've just done is I've just made an assumption. If you're an accountant, you want $1 million of life insurance, disability, income protection, and your income's $100,000, how much would that cost if you go with Rest Super Fund? Now Rest Super Fund actually outsources their insurance policies, so they outsource that to TAL. So in this comparison, I'm looking at their Rest Super Fund premiums versus TAL premiums. So same underlying insurer, but the TAL policy is set up via a financial advisor. As you can see, male, date of birth is 37 years old, 100K of income, and I've just chosen a qualified accountant. I always like to just do simple white collar worker, but I can pretty much use any occupation and it'll come up with very similar outcomes. So $100,000 worth of life insurance, $100,000 worth of TBD, income protection, and a 90-day waiting period only for 5 years. That's because Rest don't allow a long income protection benefit period. Now, as you can see, the Rest superannuation premium is $1,447, while the TAL policy is $845 per year. So even though Rest withholding that 15% of the premiums, so it's automatically just artificially boosting that premium by 15%, even if we factor in that 15% being passed back to members, it would still be more expensive to go via Rest than to go via a financial advisor to get a TAL policy. Now I'm sure you're going to say to me, hey Phil, the Rest PDS said the insurance reserve is used to cover the cost of running our insurance administration and for the benefit of insured members of Rest through reduction in future insurance premiums. And it's just not the case. So number one, they're taking that tax refund money back off you and not passing it on to members. And number two, the insurance premiums are more expensive going through Rest than if you went through a financial advisor and got an insurance policy with the same underlying insurance provider. Now further to that point, I just want to touch on what does that rebate look like. I've got that exact same client with quoted through TAL directly through a financial advisor, and you can see the year one premium is $965 per year, but that TAL super rebate of $144, which is that 15% tax rebate, it gets passed back to the insurance policyholders or the members, and so it means that TAL will only charge $819 or $820 per year to the super fund. So a few things to note. Number one, you can go through a financial advisor, get this policy set up, and you will access that 15% tax rebate. Number two, it's the same underlying insurance company. So if you need to claim, TAL is paying the claim on both scenarios. And number three, it is in fact a better insurance policy and a better insurance contract because TAL, if you set it up through a financial advisor, they cannot change the terms on you in the future. While REST, that policy under that group policy can change and adjust and move over time. This idea that barefoot investors said, that lots of finance commentators have said over and over and over again, that insurance through your super fund is always better, it's factually incorrect. You do not get the tax rebate from certain super funds.